This meeting is being live streamed. Got it. Okay. I believe we are now live. Ryan and Bouchey, welcome. Let me just make sure we're up and running here. I've never live streamed from a hotel room on Zoom. So
neither had Jake or Brody, whoever just walked by in the background.
Whoever just walked by, exactly. Guys, welcome. Todd and Ryan here, New Age Wealth Advisors. We are live streaming. I'm coming from a hotel room here in Park City, Utah. That's where I look like a college kid who just rolled out of ski team practice. Ryan's at home in Boston. A bunch of snow back there, I believe.
Yeah, we got about a foot, it looks like, outside. It's just slowing down. It started overnight, and kids were off of school today with the snow, and hopefully we can enjoy some sledding here over the weekend. It's we really got a pretty good storm that ripped through.
Nice. Just give me 1 second. Let me just see here. Show manage participants. Just give me 1 second. Again, I haven't done this before. Viewers, let me just ask you guys. I see a few of you logging in. Welcome. Are you only able to see me, or do you see Ryan as well? If you don't mind just typing in, let us know. And then let me get this done properly. So ready to go here. Okay. It looks like we're flipping back and forth. Okay,
cool.
Oh, good. Okay. Back to meeting. Oh, there we go. Okay, good. Let me just get the YouTube comments up here. Hi, guys. Those of you who are in here now, sound is okay. You can hear both Ryan and I. Would just give us a quick confirm on that, and we'll get rolling here. Okay. Okay, great. Thanks, Stephen. So welcome. Yeah, we thought we'd do, again, traveling this week. So off our normal schedule. We are here in Park City, Utah, doing a family ski trip with our friends in Saratoga. We traveled out here. We had about 5 or 6 inches of snow. They haven't had snow here in Utah in a month. And of course, what happens at home? They get a foot of snow. I think upstate, we're getting a foot of snow. Ryan's used to getting bombed in Boston. But it's been good. It's been fun. I took Eden out skiing. Let me see if I can show you guys this quick, and we'll get into it quickly. If I share my screen, I'll just show you this. Share. I don't know if this is going to work. Share screen. Okay. Advanced. Desktop 1, share. Open system preferences. Oh boy, maybe this isn't going to work. Anyway, I told you we haven't done this one before, but no, we had Eden on the harness. Maybe I can just show you this way. It's kind of cute. Let me just show you this. Maybe we can just do it through this way. So we had her, so that's my wife and Jake and Brody, and just this little harness strap system, just hold her, and it's her second time skiing. She stands up pretty well.
She looks like she's ready to rip.
She was doing pretty well. She wanted to go back out. It's cold here, but you know what the difference is the humidity. It's so dry. This is high desert. So it's 15 degrees out here, but it feels like it's 30 home. It's just, the humidity works both in the hot and cold. It just makes everything more extreme. So,
and it makes the snow great out there, right? Isn't the snow a little bit lighter than you might get, especially on the East Coast, but even some of the other places on the West Coast? From what I remember, I was out there a long time ago, but just remember the snow being so light, and if you get fresh snow, especially, you just glide right through it. It's like nothing.
Yeah, it's so dry. There's just no humidity, so it just creates very, very light snow. And it's good. My friend, the other Ryan, he works at ACO. He does structured notes and options. This Ryan knows him. We were skiing up at the top and through the trees, and beat each other pretty good. So today was an easy day. Just skied with the girls, and cheers, local Utah IPA. It's happy hour now. Markets are closed. So yeah,
Nice.
it's been good. It's been good. And I know if you guys have been keeping up, Ryan's house hunt is still ongoing. Real estate market is extremely tight. We were looking at real estate around here. I think there's about 5 houses for sale in Park City. I saw one for like 1,600 square feet, starting at 2.1 million for
That's
1,600 square feet.
that's a tougher market than what I'm dealing with, but Boston's not much better, and the search continues. So
Yeah.
I'm hoping it was just a slow week because, like I said, my kids were in school, but most of Mass and most schools were off this week. So I'm thinking with President's Week holiday, not a lot of things are coming onto the market with buyers, probably being out of town or just on vacation. So fingers crossed for next week. We'll see what happens. And I know with you being out of town and on vacation, and glad we were able to make a few minutes here. Just wanted to kind of recap what's been a crazy week, especially to end the week with yesterday's movement was pretty wild, and watching it unfold kind of real time was pretty incredible, just watching where markets were pre-market and where they ended up. And then today, another good day into the market close. And so just want to touch base with clients, investors out there, just kind of seeing what we're watching, what we're seeing, and kind of give a recap of where we've been. I know waking up yesterday, kind of, we thought that there might be some movement in Ukraine and what Russia was planning. The fact of the matter that they kind of went with a full-on invasion of Ukraine. It wasn't isolated to those easternmost kind of territories that are, sort of Russian backed anyways. We thought, and even last week when we were doing this last Thursday, because that was when the first kind of news that, hey, this thing is feeling real. And I know we talked about it because it was so surprising to see, the markets were volatile, the markets were down. But what was strange at the time was oil didn't really have that bump that we would have probably expected because of, how much energy and natural gas is supplied by Russia. You would think if there was any sort of major geopolitical issue coming out of there, that would be one area that you would see kind of rise, and that was down. And it felt almost to me at that time where, there's trading and there's sell-offs going on in the market because of some of this uncertainty, but it didn't feel real. And then we kind of get into the middle of this week and yesterday morning, and we're seeing the entire country of Ukraine being invaded. I mean, it brought on a much different feel and different set of scenarios that I don't think didn't think could happen, but here we are. And so for the markets to start down 3% yesterday, finish the day, well, the NASDAQ had a 6% swing, starting down 3, up 3. Again, another pretty good day. It's just wild movements in the market, and probably not what we would have expected at the start of yesterday.
Yeah, it's interesting. I think you bring up a good point. Energy was well bid. I mean, we've been overweight energy in our growth and our value portfolio for some time, and it's probably been bid up as a result of obviously inflationary pressure. So it was already overbought going in. And then, of course, you had the psychological $100 level that everybody's watching at crude. And I think crude is up about $6 yesterday, tagged 100, sold off, back around 92 now. So I think a lot of it, there's a lot of buying that already happened in the energy markets heading in. And, I'm trying to figure out how to do screen share. I don't know how to do it. I'm sorry. I have a few things I wanted to show you guys. But I immediately thought about the first 2 Gulf Wars. There's a lot of precedent for, stock selling, crude or in energy buying in anticipation of some kind of war event. And 1991, when actually it was in 90, when Iraq invaded Kuwait, crude oil went super bid. Let me just show you. I can't show you, but let me just give you the prices here. So yeah, again, I wish I could share this, but crude oil spiked up from, it was $16 a barrel in June of 1990, and then it went up to $40, $16 to $40. The top was in October of 90, and then I believe when I think I think the U.S. went in January of '91, and the stock market had already rallied, crude oil had already sold off. So round trip, basically from 17 to 40, back down to like 19 or 18. So, and I know Tom Lee, who I'm a big fan of, and a friend from CNBC, and I know he was doing a lot of research showing that there's a lot of precedence for stocks to actually rally when military action actually goes into effect, unfortunately. So I think there's a lot of precedent for this. So I think from the technical point of view, those of you who know me from the old technical world too, again, I'm going to do my best to describe this. I'm sorry, I've never done a Zoom kind of live stream. I don't know why I can't share my screen, but this whole sell-off from the S&P from January 4th was the high. We sold off into January 24th, rallied back up into early Feb and sold off. Guys, it's just those of you who know anything about corrections of the way markets trade, it's just a big A, B, C correction. The S&P, I really thought the S&P was going to go below 4,000. And I wanted to kind of prep and sort of get our clients at New Age comfortable with the idea, like, look, it might go 38, 3,900, but I think Ryan opened it up well and saying the response has been really, really impressive coming back. I think, 4,150 may have been the low. I don't know. But the last 2 days upside has been very, very impressive. I think there's some pretty good leadership here. Just looking at sectors again, just forgive me, I'm kind of stumbling my way through this because I'm not at my home setup, but just looking at the sectors that are leading it. When Ryan and I were just talking about this, it's a lot of materials. I was watching at aluminum, non-ferrous metals, not even oil so much, but materials have been leading it. So looking at the sectors and industries today, it's metals and mining, and then interesting regional banking, which I want to look at interest rates in a sec. So it's metals and mining, regional banking, banks, materials, home construction, consumer staples, financials, home builders, utilities, healthcare. So we're getting a rally here, but it's really kind of led by value in interest rate sensitive sectors. So I'll wrap up here in one sec. I just want to check. So 10 years at 1.98%, up 0.8 on the 0.86 on the session. The 30-year is only up 0.13, and that's at 2.23. So it seems like it's not great. It seems like maybe the middle part of the curve is kind of moving up here. Shorter term rates are moving up. And the other thing that I'll finish right here, the possibility of a 50 basis point cut in March has been significantly scaled back. I'd be shocked if they hiked 50 in a pending, unfortunately, this is getting nasty, I think, with Russia. I hope we're over, obviously, the worst of it. And I know there were lives lost, but the possibility of a 50 basis point hike is only 21% now for March. They're at 78.9% for a 25 to 50 basis point range. So it looks like 50 bips is off the table in March, which I think is good. I just don't know if the market could handle 50 basis points hiking with escalating tensions. And the last thing, I'll throw this to you, Rai, is, China, I'm a little nervous with the way China is handling this. They're refusing to classify this as an invasion by Russia. I think we can see where China stands on this invasion. And I really, really, for everyone's sake in the world, I hope it doesn't escalate. And I also found it interesting that Russia threatened Sweden, and I believe it was Finland. They want to try to gain entrance into NATO. And they said, if you try to gain it, if you try to go to NATO, we're going to come after you. And I saw that headline. I checked it from the Lifted, and I said, oh my God, like this is going outside of just Ukraine. I thought the market would be down a lot more, and it handled it really, really well. So I threw a lot at you, but there's just kind of thoughts that I had just watching here from afar.
No, and that was one kind of big lesson that I learned, was just how much NATO has sort of led to this kind of pushback from Vladimir Putin in Russia. I mean, it really feels more as though, it's really being driven by Putin more than even the Russian people, right? There doesn't seem to be a ton of support for what's happening, but I didn't realize how much of an impact kind of the early stages of NATO and kind of getting to that Eastern Bloc made a difference back in the 90s, which, was encroaching on the new Russia, as the Soviet Union kind of collapsed and Russia was coming up. they felt really threatened by the expansion of NATO, and this kind of stems from there. That's what they're using as kind of their basis for this invasion. And so a lot that I've learned about what's going on over there, and it's hard to even say how it's going to play out from here. I mean, again, from initial reports, it sounds as though some of Russians' advances have been kind of stymied to a degree, but again, there's just not a ton of, seems like, reliable information right now. And so it's, who knows what the weekend's going to bring as we head into Monday, where the markets are going to be. But as you kind of alluded to a little bit with the interest rates, it's almost potentially over these last 2 days where we've seen these conflicts, these overseas conflicts haven't disrupted the markets too bad in the past, and from a historical context, although they tend to kind of disrupt it from a short-term perspective, whether a couple of days or a couple of weeks. But in terms of kind of seeing the backing off of interest rates, maybe some of this, and to your point, you had said, it'd be hard pressed to see the Fed bump up interest rates by 50 basis points when we have everything going on internationally, this geopolitical disruption that we're seeing. And so maybe some of the bad news out of Russia has actually been good news for the market in terms of kind of backing off that quick rise in interest rates, because that's kind of been the biggest headwind that we've seen. And I was writing about it over the last couple of days.
Okay.
Do you know we're doing YouTube? What's all over your face? We're doing YouTube right now. You're on YouTube.
I'm hot Cheetos.
Hey, you're on YouTube right now. You can't hear because I got my. They love YouTube. Sorry, go ahead.
So with regard to those interest rates, and I was kind of writing about this, is, I mean, when you look at how we came out of COVID and where we bottomed out in March of 2020, and just kind of the overall market coming through 2021, I mean, even though I think the fundamentals are still there, strong economy, strong corporate balance sheets, all these factors that are really positive in the country for that sort of exponential growth with little volatility that we've seen over the last year and a half, 2 years, that couldn't continue. And with interest rates, with inflation, there was good reason to have some of this sell-off. And kind of when you take a step back, I mean, we've been talking about this, the recent sell-off has been pretty routine in terms of historical averages in the pullback. I mean, it never feels good when you're seeing it. Growth is getting hit more than the overall market. And we've talked a little bit about, inflation pressure is going to hit those stocks more than, maybe some of the more value-oriented stocks. But when you see kind of the volatility that we've seen, it's not that far off what we would otherwise kind of expect this. I mean, you can't time it. Like, there was no way to say, hey, this is going to be at the top, there's going to be pullback, but you just felt at some point. And I think with rates, with inflation, and now with Russia, although it's reverse course the last 2 days, it's kind of just given investors, I think, enough reason to, either rebalance, take some gains off the table, whatever it may be. But to your point, I mean, there's still, the underlying fundamentals, plus the fact that now, stocks are more appropriately priced all of a sudden, right? We're still getting, good forward guidance, strong earnings moving forward in terms of what's being kind of put into the numbers. And now that the markets are off, in some cases, 10, 15%, they become, the overall fundamentals become a lot more attractive. So, I think so far, again, it's easier said than done. Feels more of a healthy pullback. But obviously there could be, continued disruption as what we're seeing overseas.
Yeah. It's there's a lot of good stuff you just said there. And I saw something from FactSet. I got an interesting email from them. S&P 12-month Ford PE right now. So Ford PE of the S&P is 18.5, which is right on the 5-year average. So we went up as high as 24 times forward earnings. So I think they're making, S&P is looking at $228 in total EPS estimate. So 228 divided into the price of the S&P, 42.25, puts it at 18 and a half times forward earnings, which it got up as high as 23 times earnings. And that looks like that was in late 2020. So late 2020 was the highest. October, November were 24 times forward earnings. And then we've just steadily sold off through 21 and now into 22, and we've taken a sharp drop down to 18 and a half, which again, I wish I could figure out a screen share on this. 18 and a half was the high actually from 2018, looks like beginning of 18, and then right before COVID, 18 and a half seems to be the pivot. But again, that's the 5-year average. So you can't say stocks overvalued now. They're in fact very averagely, but that's not a word, but it is now, valued right around the average. And we've talked about this before. The margins are increasing drastically as companies are becoming more efficient. And that's why we've had such a big tech rally, is because so many different sectors and industries are incorporating technology to increase their efficiency and their earnings power. Companies are making more money than ever. With this sell-off, the markets have become more fairly valued. And you said something interesting earlier, Ryan. You were talking about volatility, and I was on the chairlift talking to the other Ryan. Again, he works for ACO. He's my buddy. ACO is one of the largest private wealth management companies for Goldman Sachs, which both Ryan Bouchey and I have a lot of friends that work at ACO. We were talking about this. In presentations I've done in the past, I've got this chart that shows 100-year range of the Dow, and it basically looks at high to low on average per quarter. Okay, so 2016 and 17, I think we were ranging at about 4.5% per quarter range. So high to low on the Dow, which looking back is the lowest volatility in over 100 years. So even before like 1912 was the last time the range was so low. So we're talking about century low ranges in the Dow. So since 17, 18, 19, now we're into 22, we're seeing mean reversion of volatility because the markets were so quiet, so complacent, just going up. In 2016, 17, 18, we're starting to see a pickup, a mean reversion of volatility, which is why we're seeing such drastic swings back and forth, which seems uncomfortable. But this is actually, this needed to happen, whatever event is going to drive volatility. And that's why I do think, I hate to say it, that's why I do think passive investing, just index investing, I think is increasingly being phased out because we're seeing mean reversion of volatility. You're seeing certain stocks and companies that have embraced technology that's available to increase their efficiencies and margins who are getting priced up, and we're getting obviously the ones that are not are going to be left behind. We have inflationary pressures now. So again, our growth portfolio, Ryan, if I told you we're going to launch with 3 times the weighting and energy in our growth portfolio, I would have been shocked. So there's a lot of stuff happening right now. And of course, that's going to be the way it goes. Like if we launched the RAA 2 years ago, Ryan, it would just be long NASDAQ, AMD, Apple, NVIDIA, and just be making a ton of money, and it's easy. It's a different market now. You really have to stay on top of it with all these forces. You've got inflation, you've got interest rates moving up, and you've got geopolitical risk. So there's a lot of opportunity in here, but it's a busy market.
No, and I'll just kind of recap or kind of end that thought with, even when you look at how last year ended, and I was writing about this a little bit as well, is, a lot of the COVID darling companies that really had a great run up through 2020, about midway through 2021, they really started to come back to earth. And I mean, and they fell back in a hard way. And they were a lot of like different technology companies and some of these like a Zoom, Pelotons of the world. I mean, they had some pretty substantial pullbacks this latter half of 2021. And now the overall market was doing well. And so I guess on the flip side, right, like in that kind of environment, the passive does work. But now that we're seeing kind of different opportunities present themselves with kind of this divergence, right, in the market, there's not so much of this highly correlated everything kind of going up. We're kind of seeing some displacement, some divergence, and less correlation. I think that does present itself with more opportunities to kind of look at the market as a whole and be a little bit more tactical with it.
That's a great point that you just made, is when volatility increases, to my past point, in terms of, we're not talking about one-off, situations that create volatility. We're having mean reversion to higher volatility. And when you have higher volatility, you do have less correlation. There is an inverse relationship between volatility and correlation. When things are quiet and the VIX is, we had sub 12 VIX or whatever, 13, 14 VIX. Markets are very correlated. Everything's trading together. But when you get 20, 25, 30 VIX for a sustained period of time, those correlations fall apart. And you really need to know what sectors and what stocks to be in. And then, one thing I forgot to bring up, and you and I were talking about this, just kind of prepping for this meeting, I was trying to figure out why are materials leading this on the way up? And I didn't know this. I have to plead ignorance on this. And I didn't know how many I knew, natural gas, I think Russia supplies 40% of Europe's natural gas. And I think there's a key pipeline that goes through Ukraine right to Germany. So I wasn't surprised on the natural gas. But let me just find this tab. Just looking at all the materials that actually do come through Russia. So just going to throw a couple stats at you. Just looking at this Reuters article, and here I'll drop the link in the YouTube window here. But grains and oilseeds, Russia and Ukraine were major wheat suppliers, accounting for a combined 29% of global exports, the bulk of which go through the ports of the Black Sea. So grains, gas, and power. Europe relies on Russia for about 40% of its natural gas. Most comes through pipelines through Belarus and Poland, which go to Germany. Aluminum. Most Russian metal producers have so far escaped sanctions imposed by the West, blah, blah, blah. I think Russell, which is a Russian aluminum company, produced 3.8 million tons of aluminum in 2021, 6% of the estimated world production. Cobalt. Russia produced 7,600 tons of cobalt last year, 4% of the global total. And then Nornickel. I don't know what Nornickel is. I'm going to have to, again, plead ignorance. Largest producer in Russia, selling 5,000 tons. I don't know what percent Nornickel is. Copper. So Russia produces 3.5% of the world's copper production. Nickel, 7%. Palladium and platinum, 40% of the global mine production. This is an incredibly interesting article. I didn't know how resource rich Russia was. I thought it was more crude and natural gas, but that's why we're seeing a really big bid. Is as Ryan was saying earlier, we're back to supply chain issues. So the price of materials are going up with scarcity. So go ahead if you want to jump in there.
Well, I was just going to say, I think I was kind of thinking about this over the last couple of days. When you think of Ukraine, doesn't have much, they have a very small economy. Russia is not the same, superpower, if you want to call it that, from the past. But they're the two of their economies together is about 1.5, 1.6 trillion, I think, a year GDP. We have 3 states in our country that are bigger than that, right? Texas, California, New York on their own. So kind of when you think about the conflict overseas, it's probably not going to affect some companies that are, mostly doing business in the US or developed Europe or even developed Asia, software, things of that. But, I do think it's going to be interesting to see how some of the supply chain, because there's enough raw materials coming out of that area, both Russia and Ukraine, that there could be, maybe longer lasting effects on the supply chain and, certain companies that rely on those raw materials from an upstream raw material and supply chain perspective, but also as we talk about inflation, right? Some of the COVID supply chain issues, talking that they're going to be a little bit more transient. How does this affect that to a degree? Because you may run into similar issues in terms of having some hiccups there, and does that continue to affect prices going forward? So,
sorry, I don't want to. Please continue.
No. That I was kind of wrapping up that point. Just something, as we're kind of seeing this play out, some of those issues to consider moving forward.
And I think I hate to make this blanket statement, but I think the general consensus of Russia, I hope I don't offend anyone saying this, I think is cautious. And I think, perhaps the supply chain issues and workers not wanting to go in because of COVID, maybe it's going to be like a 9/11 situation in New York. Everyone comes together, everyone in the global community in the West and everyone NATO members, maybe everyone comes together, opens up, maybe we go back to work, maybe we realize, okay, sort of party time is over as I'm here in Park City, Utah. But what I'm saying? I wonder if people will sort of go back to work and kind of stop this elongated vacation we've had from COVID and sort of ease up these supply chain issues. Of course, as COVID is really coming off now, I wonder if the world's going to kind of kind of rally around and maybe go back to work and focus, because I think Russia's a significant threat.
Yeah.
Watching headlines out of China, I'm just so nervous. I think Biden's comments yesterday were a little scary. He was saying, this is, if things don't fall into line quickly, this could get ugly real fast. And I think that's an accurate quote of what he said. So we just got to watch how China handles this with Russia. I mean, we clearly know where those loyalties lie, and the way the market is handling this, it seems like this thing is going to de-escalate fairly quickly. So leading into that, Ryan, I know, is writing a nice piece. I think it's just about done, sort of a taxable strategy to take advantage when the markets are down, and that's doing a Roth conversion, which I thought was really interesting and timely, especially as the market's kind of moving back up off the lows. Do you want to tell us about what that is and where we can find that article?
Yeah, we can get out on this. We were talking about it too. In times of volatility, right? It's a good time to just reassess your overall allocation. And I think it's always good to take a step back and just say, okay, how am I invested? Is really my investments aligned to either short, intermediate, long-term goals? And if they are, there's usually not much to do here. You can be tactical, but nothing major. We talked about, we had more of the advantage of looking at some tax loss harvesting. Times of volatility, we'll see how the markets react kind of coming into next week. But that's something that could be on the table to consider if there's opportunities there where you can take advantage again of the volatility. And then, lastly, in finishing it up now and should be on the blog, actually might be on our blog right now, but just talking about doing some conversions. If a Roth conversion is right for you, and there's a lot of different factors that go into it, but we continue to say, with the markets being down in this volatility that we've seen, it's a good time to transfer over those assets from a traditional to your Roth. Again, if the circumstances are right for you, but you kind of get the advantage of shifting more shares over, right? If you've had a little bit of a sell-off with more upside potential in the Roth, which is what you want to see. So it's kind of a win-win if you never can time these things perfectly, but obviously it's a good time to kind of think about that. Especially if it's something you've been considering, or if it works well for your overall plan. I think now is a good time to really consider it. And like I said, we've been reaching out to clients and talking to them about it. It's definitely a good time. And even if you kind of know you're going to have a set number in mind, you can do a portion of it now in case you believe there's going to be more of a sell-off as we continue through the year. And so you have a lot of different chances and opportunities to do it. So just something to consider and think about. We try to always factor in kind of tax planning, how we can maximize. And as we say, it's not how much you make, it's how much you keep. And so if you can do some tax planning and make some good moves and timely moves, it can certainly help long term.
Yep, love that. Love that. That's great. Yeah, it's a combination of efficient planning, tax strategy. We feel active portfolio management and harvesting losses. We rebalanced the portfolio. There's some stocks were down. We kicked out the weak ones and created some tax losses so we can offset against gains for our clients. I think that's the future. I think that's the way we've built the business. So be sure to get on our email list. Just check us out. We are at newagewealth.com. There should be a link below. I'll update that. Just get on our email list, and we might send 2 emails a week. That would be the most. So we certainly won't spam you there. Obviously, we protect your emails. So check that out. If you're watching on YouTube live or in the recording, if you don't mind, just clicking that little thumbs up button if you've enjoyed this, and let the other viewers on YouTube know that this might be helpful. And appreciate you hanging out here with us on Friday afternoon. Cheers from Park City. We're gonna go check out the town here. Beautiful. Real estate is insane here. I think I already said it. I checked it out. It's like 5 houses. Looking at Zillow, there's like 5 houses for sale in this whole town. 1,600 square feet starts at about $2.3 million. Like,
must be nice.
There is so. We went to Deer Valley as well, which is the sort of neighboring area. The first night, unbelievable. Some of the beautiful houses, and I've actually stayed here my buddy from college, Thomas Vaughn, who's Lindsey Vaughn's ex, he's a ski coach. He used to live in the neighborhood up here, and I've stayed over there. And just so what a beautiful, beautiful area up here. It kind of ruined skiing for the East Rye, unfortunately, man. It's just so unbelievable out here.
I know. The last time I was there was 20 years ago, give or take, and just amazing memories.
I was here 10 years ago. I didn't even recognize the place. It's just, the place is booming. And I think the Olympics are coming here in 2030, I believe.
Okay.
So they're putting a ton of work in getting ready for the Olympics. And I actually saw this is the home of the US ski team. And I follow the guys on Instagram and everything. They were training. The US ski team had just got home from Beijing, and I could see the trail they were training on. So I didn't go over there. It's all obviously closed to the public, but the US ski team was training here. It's pretty cool. So
great, man. Well, hey, it was good catching up. I'm glad I haven't talked to you much this week, so I'm glad we.
I'm sorry.
We got a couple, half hour together here, and no, I'm glad you guys are enjoying it. It's
did you miss me, Rye?
Yeah, I think this was the most we haven't talked since we started working together. So missed you a little bit, but know you'll be back in a couple days, so can look forward to that.
That's it, man. No, it's all good. And yeah, we're in good shape though. We're in good shape. Portfolios, I think, I think they're well allocated. I think we're doing well compared to what's happening out there. And it's not a time to panic. Things are built, and we have the planning is done. And I just don't think it's a time to panic in here. I think it's it's hard to be away when the markets are so volatile like this, but there's nothing I really would do here. As you said, it's a very typical sell-off in what should be, I think, a much deeper correction, considering, that we're, since the Cold War, I think our relationships with Russia haven't been so stressed. And I think the market's showing a lot of relative strength. So I don't think there's a lot to do here, unless, as you said, you can do some planning and tax strategy and sort of take advantage of the sell-off if you do have some cash. And I do know we have clients with cash, so we're watching closely. I think there's opportunity in here.
Definitely. Well, on that note, I think that's a good way to end it. Like I said, enjoy the rest of your guys' stay. Tell the fam said hi, and I will. We'll talk to you next week.
All right, sounds good. Thanks everyone for listening, and we'll be back next week.
I bet. See ya.
All right, take care. Now, I know I'm still live. How do we stop this thing?